Greetings, my name is Kevin Matthews and I am the tax professor. Welcome to class. Class is still in session, so the learning never stops. Glad to have you back here. So today, it's kind of funny, in a previous video we kind of talked about types of retirement plans. And I had some people who had seen the video that actually came to me and said, hey Kevin, can you do me a favor? I really want to talk about some of the more, meat and potato type stuff, which, and look, I understand. So something that I try to do with these videos, believe me guys, if you didn't give me a 10 to 15 minute time constraint, I could talk forever and ever and ever and ever and ever. Okay, so when we take these tax topics, we try to chop them up into small bits. And so this time we're going to go ahead and we're going to talk a little bit about the 401k plans specifically, because, and I think it's a very good one to talk about because that's the one that most people know about, and it's also the one that most people probably have. And look, I want you to understand, when we talk about 401k plans, there's different types of 401k plans, okay? So, and then there's, and 401k, it's actually kind of funny because very rarely does a tax code really become vernacular to the entire world, the entire population of the United States. You say code section 401k, people kind of understand, it's probably related to the retirement plan if that's what they've got, which is true. But the 401k, there's different types of 401ks, but again, because of that vernacular that I'm kind of talking about there, there's people who refer to things as 401ks when they're really not 401ks. I'm not going to talk about a whole lot of that. There's simple plans, which we have talked about in previous videos. There's IRAs, which we've talked about in previous videos. And then there's also, of course, this 401k plan that a lot of people will have an opportunity to participate in. So the way that this is going to kind of go is that we're going to kind of talk about that, how is it that a 401k works and what are some of the things that, that you can get as benefits from the 401k. So as we go ahead and we're going to kick this off, we're going to talk about, the 401k plan. And of course, in the grand scheme of things, we've talked about two different types of plans. We have defined contribution plans and we have defined benefit plans. Defined contribution plans is basically the type of plan where I know how much money is going in. I have no idea how much money is going to come out. Defined benefit plan, exact opposite. I personally don't know how much money is going to go in, but I do have a good idea of what's going to come out. And I'm talking about from the employee side. Now, obviously, the employer is going to have a very good idea as to how much money is going in because they're paying it every year as defined by the actuaries. 401ks are a little different in that sense. What's happened is that with a 401k plan, actually, let me back up. So if you think about it, in a defined benefit plan, who has the risk? Okay, the risk is on the company who actually offers the plan, because if they don't do things correctly or if things go absolutely wrong, they're still out a lot of money that they have to pay you because that's what they've told you you're going to get. Okay, you did your bit for king and country, in this case the company has to do something for you, and so that's why they do the defined benefit plan the way that they do. It's also an aspect of why they're not as popular anymore, because no company, how many companies last more than 100 years? I mean, maybe Coca-Cola, GE, I could name a few, but not every company is going to last more than 100 years, and so they don't know what they're going to need in order to be able to do certain things. And now there's a pension benefit guarantee corporation that can help alleviate some of that, but nobody wants to deal with that. And then the actuaries and all that stuff. So a lot of companies are moving towards this defined contribution plan because it's very simple from the employee's perspective. You put money in your plan, I'm going to put it away for you for retirement. And as a part of this, though, I'm also going to contribute part of this as the company into your plan in order to give you a bigger retirement egg as a result of it. The good news is the contribution that I put into this plan will not be taxable to you. The contribution, but I do get a tax deduction for putting it in because it is an expense that I have. So it's kind of the best of both worlds. Now, when I say it's not taxable to you, that's not 100% accurate. It's tax deferred to you. In other words, under a traditional 401k plan, if the company make a contribution to your 401k plan, it's not taxed to you until you withdraw. Okay, kind of works the same way for you with your contribution. You get, except for you get an immediate tax deduction, and in exchange, you have to pick up the taxable income when it comes out of the plan. So under the 401ks, you have the option of either receiving amount of cash or having the cash set aside in a qualified retirement plan. By electing to have it set aside in the 401k, you will reduce your gross income. That's a very key factor in these traditional 401k plans. You can make a contribution, and in 2018 it was up to $18,500, and there's a $6,000 kicker that people age 50 or over get to make, and so you could effectively reduce your salary that's subject to tax by that amount of money that you make as a contribution during the year. And so it's a way to reduce your taxes in the current year, which can, for some people, this is the only way they get to reduce their taxes because there's not a whole lot of options left to them. And so, it's something that's very good. And it's one of the few things that, even some high net worth, high income earners can actually contribute to 401ks, which is, thank God. That allows them to save up for retirement and all that stuff. And it actually works out. There is one thing about this, though, and most people probably are not aware of this. If I ask the average American, how much do you pay in Social Security and Medicare taxes, they're not going to have a clue. And it's just because it's taken out, it's out of sight, out of mind. They don't even think about it. It's part of that FICA withdrawal that they see on their paycheck, and they're like, who's this FICA guy that's taking all my money? Well, that's Social Security and Medicare. Okay. When you make a contribution to a 401k plan, the wages that you contribute to the 401k plan is still subject to that FICA tax, that Medicare and Social Security tax. And so, unless you're making more than the statutory maximum for the Social Security, which is entirely possible. So, what ends up happening is that you will still pay taxes on the money that's going in there immediately to Social Security and to Medicare because there is no way to be able to do it. Okay. Another thing to take into consideration, if your employer plans allow you to instead make contributions on after-tax basis, these are commonly referred to as Roth 401ks because they work kind of like the way that a Roth IRA works, but it's a 401k, so it needs to be considered that way. What'll end up happening is that the amounts that you roll over are subject to current taxation, but if you leave them into plan for a long time, you're going to be able to take them out tax-free. I'm going to be honest with you folks, if I was still working for like one of these big companies that had one of these Roth 401ks, I'd take it. Unless you're like in the 50s, early or late 40s, early 50s, where there might be a little gray as to whether you should be doing it or not. If you're in your 20s and 30s, this is the way to go. And I'm saying from a tax perspective, not a financial perspective. Obviously, that's not my swim lane. I'm not trying to get into there. And seek a financial advice if that's something that you want to take a look at. So again, we've talked about this, in 2018 it was 18, actually it's going to go up in 2019 to $19,000. When you reach 50 years old, you can do catch-up provision, which is $6,000 extra. So if you're 50 or older this year, you're able to make contributions up to $25,000 in order to, as part of what you're going to do. You cannot make more in contributions than you actually make in salary, which kind of makes sense. And then your total contributions plus the amount that the employer puts in cannot be more than $56,000. It's very interesting because when I talk to a lot of people about 401k plans, they have no idea about how much money that the employer is putting in, other than they just match up to 3%. Well, it's a little bit more complicated than that because they are putting in that money, that's correct, but they have certain statutory limits that they have to maintain in order to be able to do the contributions the way that they want. The 3% is generally a safe harbor rate, and so that's usually why a lot of employers go with it, because they just want to do whatever safe harbor asks them to do, and so they don't want to get too creative for it, because the more creative they get, the more expensive the plan gets, and so that's part of the reason why they don't do it. Typically, you're allowed to invest your amount of contributions among available options that your employer has selected. And here's how this is going to work. Your employer wants to attract you, so they're going to set up a 401k. So So what they do is they go to a company to set up the 401k, and the guy will sit down with them, or gal will sit down with them and say, okay, what kind of 401k do you want? They set up this stuff, blah, 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 so on and so forth. Then they come to the decisions. They say, okay, what kind of investments do you want available for it? And they're going to have a range of investments that they're going to choose. And I'm not trying to pick on the financial industry. I have a lot of respect, actually, a lot of very good friends that work in the financial industry. Oftentimes, the choices that they have for the 401k is just not that great. I remember when I worked in the federal government, when I was in the Navy, TSP, I want to say I only had probably about 10 choices. That's about what you're going to get in a 401k also. A lot of times, and a lot of the choices that they're going to do nowadays, they do these what they call target funds. So they're going to say, are you going to, if you want to retire in 2020, this is what funds we're going to put you into. If you want to retire in 2030, these are the funds this is the fund we're going to put you into. 2040, 2050, and so on and so forth. And what happens is that the further out your date is from retirement, the more risky that they're going to do in their investments. And that's because they're kind of taking the advantage of, hey, this person's got years before they're going to retire, so if something goes in the market and goes bad, they have plenty of time to recover. Somebody who's going to retire in the next 4 to 5 years doesn't have that flexibility, and as a result of which, they're not going to put that money to risk any more than they have to, and so that's one of the reasons why they do those targeted funds the way that they do. So, I want to invest in Europe, or I want to invest in Asia, or I want to invest, so they're going to have those kinds of funds that you can have that's available to you if that's where you want to go with that. I'm not suggesting that's a bad way to go. My personal opinion is that you should be sitting down with your financial planner and having sort of a holistic discussion about what you should be investing in, what you should be doing. The financial advisor knows that they can't touch the money that's in the 401k, because you're still working there. Now, of course, change jobs, different story. Hopefully you're going to roll it over to them. But we'll see. I'll let you have that conversation with them. So what will end up happening is that, like I said, you're going to be able to do these investments. You want to be careful not to do the set it and forget it mode, okay? It's very easy, and that's why I really don't like these target funds as much as a lot of people do, because it's just easy. Oh, well, I'm just going to contribute in 2040 because that's when I'm planning on retiring. I'm going to retire between 2035 and 2040, so I'm just going to put it in 2040. And it's set it and forget it, and that's not the wise way to go, in my personal opinion. You probably want to make sure that you're being adequately diversified, and that you want to make sure that you're taking care of things correctly. And so it's very important, in order to get that done, you have to do periodic reviews of this. Now, some people with 401ks, for some reason, they're like, set it and forget it. I don't want to deal with it. I've got a trustee that's going to handle all that sort of stuff for me. Here's the problem. You're paying for that trustee. I'm sorry to break this bad news to you folks, but you pay for that trustee. The fees that come out to manage those 401ks aren't always, the employer does have certain fees that they have to pay, but you are also paying part of that trustee fee, okay? As a result of that, what you want to do is that you want to go and spend some time with whoever that trustee's company is, if you can. And look, the trustee's company, oftentimes, they're not these guys that say, go away, little boy, you bother me. They oftentimes want you to show up. Now, of course, they have a sales motive, and I get that. That's fine. But you're also paying for this person, so if the trustee comes out to the company and says, "Hey guys, we're going to do an annual review of everybody's tax return, not tax returns, but the 401k, see how things have been going, blah blah blah," and then we're going to kind of talk about some stuff, and then at the end of the presentation, they're like, "Hey, if you ever want to come by my office, have a Coke, let's talk about things, and we'll see how the investments are going in your 401k." I always say take it. First of all, you're already paying for it. You might as well go ahead and get your free drink. And if you're not a Coke person, I'm sure they'll have water. They'll have mineral water or whatever it is that you want to drink. Sit down, have the conversation with them. At least pick his or her brain on things that are going on in your investments, and see how far it can go. I think it's a great idea, and I would not hesitate to do that if I was in anyone's shoes. I've actually done that in the past once. I thought it was very rewarding and very informative. So getting back to sort of 401ks, the big thing is that when can you take the money out? Now 401ks, usually you have to be 59 and a half or older in order for you to be able to take some of them out. Now, there are certain exceptions to these rules. I'm not going to go into those because that would take another, this video is going to go long enough as it is. We probably don't want to, go too much in the weeds about that, but there are certain rules that you can do in order to be able to get the money out earlier if you need to. And there's certain things that you can do also, so for, that allow you to do it. And we've talked about some of those in other videos. Okay. If you decide you're going to take money out of your 401k and you're not 59 and a half, you're going to be subject more likely than not to a 10% penalty. The IRS put that in there because they don't want people looking at the 401k as a piggy bank they can run to anytime they got a problem. They want people saving on their own. And so this is not an opportunity for you to just say, I'm going to put money away. Anytime I got a rainy day, I'm going to pull it out. You're going to be paying a penalty. And so you want to make sure that you are fully aware of what's going on with that before you take that out. Also, any distributions that you take are subject to a 20% withholding. If you want to get out of that, you have to elect out of it. And if and I've known many people that won't even let you do that. They're going to be like, no, we're going to take 20% out, and that's it. It depends on the plan that you're on and how they get those things taken care of. We're not going to talk too much about the contributions for the safe harbor plans, only because it's not really a big factor for you. Look, safe harbor, let me just say this one thing about the safe harbor plans. If you have a 401k safe harbor, first of all, 99.999% of human beings who are working in the United States, they have a 401k plan, have no clue what a safe harbor is, and even if they've got one or not. It doesn't matter. The only thing that matters to the employer is how much money they're required to compensate their employees through their retirement plans. And that's kind of an important factor. But if you don't like the fact that your employer is not giving you the best options, it's very likely that it's because they have a safe harbor plan. And the reason why we use safe harbor is the IRS says, look, we're gonna have these 401k plans. We're gonna have all these required things that you're gonna have to do in order to maintain those 401k plans. Employers look at it and go, I have no desire to do any of that stuff. I'm not going to offer 401k plans. So the IRS comes back and says, okay, we're going to relieve you of some of these statutory requirements. In exchange, you have to do certain things that we want you to do. And oftentimes the employers look at it and go, yeah, I can do that. So, and oftentimes it's what I want to do anyways. So they'll go ahead and they'll do it. I have a safe harbor 401k plan in my company. It's something that to my employees I can offer, and I don't have any full-time employees that are at that level yet to where they are going to do that. So I mean, it is what it is, but that's kind of the way it works out. I think it's a great way to go. It's less expensive, and things usually end up working out pretty well with that. Well, that's all I got to say about this topic in this video. I want to say thank you very much for watching. If you have any questions you'd like to ask me directly, go ahead and leave a comment in the comment box below. And if you want to reach out to me for a more one-on-one conversation, you can go to my website at www.betasolutionscpa.com. That's www.betasolutionscpa.com. And you can go ahead and reach out to me that way. Finally, if you like these videos, please go ahead and hit the like button. We're really trying to kind of spread the word about some of these topics that we're talking about. Some people like to ask, well, why are you doing this? Is this just a form of advertisement? And to be honest, folks, the reason why I do a lot of these videos is I really enjoy just educating the public. And I think there's a lot of ignorance out there in the world about taxes, and I really want to do anything that I can in order to stymie some of that ignorance that's going out there. And I really would appreciate your help with that. If you like all the at least some of the videos that you've been watching, I can't imagine you watch all of them, or maybe you have. At least if you have, thank you very much. Especially if you really like it that much, go ahead and hit subscribe. We'll give you all the updates that come along, and we really would appreciate it. Thank you very much for watching.